Okay. All right, so this is my power team. This is my power team here. Bill and Dr. Tayo and myself, some very, let's go to the slides actually. Let's go to the introduction slide that has the intro of all of us. Okay. All right, so is it okay if I introduce you, Dr. Tayo?
I can't see it online.
Okay, so this is Dr. Tayo. This is Dr. Tayo helping me out. I met her in a group called Women Rocking Business. There's about 100,000 women from all over the world. And when the pandemic hit, we were trying to figure out how to keep our shirts on our back. And this group of women actually mentored me through my online process. And long story short, just based on what I learned from Zoom, I made 6 figures online. Never left the house. You know how bad it was. And in the process, I met Dr. Tayo and some other amazing women. She's been all around the world, best-selling author. She's a radiologist, and she's a menopause coach. So please take a picture, get in touch with her. She has some amazing things to tell you about what to eat and what not to eat and different things. Sometimes you're going through menopause and you don't know why you hate your husband. I loved you yesterday, but I hate you today. Right? So, and that was just menopause, right? So Dr. Tayo is an expert there. Okay? You want to introduce me, Dr. Tayo? I don't know if you can hear.
Yes, please. Yes, I would.
Okay.
Right now, you are looking at the wonderful Rochelle Dickinson of Prima Financial Solutions. She is the CEO and is located in Virginia Beach, as she told you. And she is a life insurance and retirement expert. That means for many of you here, you're wondering what's going to happen to me when you retire.
Mm-hmm.
The earlier you do so, like we say, when is the best time to plant a tree 20 years ago? You didn't plant 20 years ago. What about what do you do? You start today. You start now, which is here, which is a 34-year-old. 34.
Ooh, I'd like to be 34.
All around the table member and a new mom and a caregiver to an aging mother.
Yes.
So that's wonderful, Rochelle.
Hey, all right.
Just all the attention, all the stories there of how you too can get what you want when you retire. And even before you retire, she's nowhere near retired, and yet she's able to live the life that she has designed. And that's the whole point of it. Okay?
Yes. Thank you. All right. I'd like to introduce you to my business partner, Bill Brown. He is the CEO of Nexus Financial Solutions, Inc. in Raleigh, North Carolina. Now, I want y'all to listen to this. He is the former vice president of financial services of the historic North Carolina Mutual Insurance Company. Do you remember the history? The second Black-owned insurance company in the United States of America. He is also the former vice president of, how do you pronounce this, Bill? AXA Financial Advisors, and he's been in the industry for 40 years. He's a father, he's a husband, and a grandfather. I have been in the industry since 1992. I've worked with many folk in the industry, and Bill is one of the humblest, kindest, the most honest person I have ever met. Up until this point, I thought that people in my industry were just out to sell a life insurance policy. You don't even know what you got. Or they're just going to put you in an investment, you lose all your money, and oh well, you signed something until I met Bill. He has been a breath of fresh air in my life. And I am not kidding you. As a woman in the financial industry, we were put in the back room. Not told this and that. You know how they have their club and they do their thing. Then Bill said, hey, I got you. You understand what I'm saying? So if you decide that you want to work with us, you have the best of both worlds. You have two people of God, as Way said, will be there right there for you. Okay? All right? So I'm sorry. I have to be. All right. So why are we here? I just pulled this off the website from the Census Bureau this week. The financial condition of women from the Census Bureau. This is what they said. Nearly 50% of the women ages 55 to 65 have no personal retirement savings. 50% of us, black, white, Spanish, Asian, 50% of us have no retirement savings. Women face a higher poverty level due to lower retirement savings account ownership, which means we don't own an account. This is the Census Bureau. The key findings regarding women's retirement financial status, the savings gap. You'll see this when you go on the website. Women are less likely to have $100,000 or more in personal savings. 22% of the women population in the United States of America. Only 22% of us have $100,000 saved up at retirement. The entire female population of the United States of America, only 22% of us. Do y'all hear what I'm saying? Compared to 30% of men. Poverty risk. Women are 80% more likely than men to be impoverished at age 65 due to the lack of saving. Racial disparities. Non-Hispanic white women, black women are almost twice as likely to live in poverty in retirement as opposed to our counterpart males. Please excuse that little spacing. I needed to. So when I first heard these statistics in 2020, I was on a Zoom call in my kitchen. We couldn't go outside. The lady was talking to us. I began to weep. I was cooking breakfast and I just sat on the couch and I started crying because I'm thinking, why? Why are we so far behind? And then a little still small voice talked to me and said, that's why you're here. That's what you're called to do. That's your purpose. Y'all ever heard that little voice? When you're crying somewhere and you hear there's just a few, that's why I'm here. Maybe 2 or 3, 2 or 3 words that set and resonate inside you. So I have dedicated myself to us as women, getting us in the back room and teaching us the things that we weren't taught. Does that make sense? Today's title is Being Your Own Bank. What does it mean to be your own bank? Okay, so let's just say Gretchen. Okay, let's say Gretchen goes to the bank and she deposits $25,000, just sits it in the bank. Okay? And then Bill comes along and he wants to buy a Mercedes. So he's going to take out a $25,000 loan. So what does the bank do? Use Gretchen's money and loan it to Bill. Now we know, we can look at Bill. We know he's got good credit, right? He just looks like a guy that's got good credit. Right? So I'm going to make this up. Let's just say Bill doesn't have good credit, but he wants a Mercedes. You know, he's not the kind of guy that flexes either. He looks like old school money. But let's just say he wanted just to flex, and his credit score was about 520, right? So what would the bank charge him in interest? Maybe 20%, right? So they're going to charge him 20% interest on a $25,000 loan. So what is their spread or their commission? 20%, right? So they're going to make 20% on that $25,000 loan. And then how often are they going to charge that 20%? Every month, quarter, year. They're going to make $100,000 easy off that loan, right? So when you're talking about being your own bank, you're talking about leveraging another person's money or another financial institute's money. Let's just say Diane, right? Let's just say Diane purchased a home. And then let's say she purchased a beach home. She purchased two homes. She rented out her beach home and she lived in another home. I love your personality, right? Let's say the mortgage is $1,200 a month, but because she fixed it up, she could charge $2,500 a month. And so easy, right? $2,500 a month. So now she's leveraging someone else to pay the mortgage, and she's making a profit off of the loan. That's leveraging, right? Let's just say Rochelle, me, let's just say I had $15,000 in cash value in my life insurance policy. And I took the cash value out and at 5% interest. And then I took that $15,000 and put it into the market with Bill. And Bill earned me 15% on that $15,000. So I paid back the $15,000 plus 5%, but my net was what? 10%. So I flipped a loan. That's leveraging. Y'all picking up what I'm laying down? Right? So leveraging is the ability to make money on someone else's money. It is the ability to borrow money to make money. Everybody say borrow money. No, well, save, but to earn. Okay? Say borrow money to earn money. Say that.
Borrow money to earn money.
Right. Okay? Don't borrow money to get in debt like the Bible says. Right? The Bible says the lender is slave to the debtor, is slave to the lender. They're talking about people who don't know how to make money with a loan. They're not talking about Bill Gates, right? They're not talking about people who know how to Disney, how to borrow money and make money on what you borrow, right? That is leveraging. Anytime a company gives you money, free money, matching money, right, in your 401k, that's leveraging, right? Because they're giving you their money and you're earning money on it. Are y'all picking up what I'm laying down? Okay, so examples of leveraging. Okay, I'm just going to hit it all. Okay, so matching funds in your 401k or anywhere that a company's going to give you money, that's leveraging. Now, during the pandemic, my agency at that time, I was just selling life insurance. And my agency at that time introduced us to annuities and growth accounts. And I saw this annuity where people put money into it and the insurance company gave them free money. It's called a premium bonus. And then I asked myself, why didn't Warren Buffett tell us about these things? Right? And it was just a small thing. They only gave 10%. So if you put $100,000 in there, they gave you $10,000. And my friends went banana nuts because I'm 58 and they were losing money during the pandemic in their 401ks. And I said, hey, I got something that they'll give you 10% when you deposit money into it. And my friends went banana nuts, rolling their money off the stock market, making it safe and getting bonuses. Right? So that's leveraging. Anytime a company gives you free money, say free money is leveraging. Say, I know because I had a husband. Right? Boyfriend, right? Women, we know how to leverage, don't we? All day, right? Earning interest and dividends is leveraging. When you have a bank account and they're only paying you 1% interest and then they charge you fees, is that leveraging? That's losing money, isn't it? Right? So leveraging is when you earn dividends or interest. Life insurance, I just told you how I flip my life insurance policies over and over again. I flip the loans on them. I'm not going to go to Carvana and take out a loan at 15% interest a month. No, right? Home equity line of credit is leveraging. When you inherit a trust fund from a relative, you leverage your granddaddy. You leverage your husband. When you inherit life insurance money, you just leverage the person who left it for you. Right? Does all that make sense? So I put my finger here and I tap. Okay. All right, so listen, we promised you 5 power moves to become your own bank, okay? The first power move is to make sure that you have at least 6 months worth of emergency funds set aside in the bank at all times. And I'll be transparent for you, this was hard for me. Because I like to spend $250 on my hair, can you tell? And when you got to get it done, you got to get it done. Where's the money at? So women, we were trained to spend. We were programmed. They called us gold diggers, but they did it to us, Bill. You want this? You want that? Right? Yes. Are you going to say no? Yes, I want it. Yes. Right? So spending was my thing. But I had to set up something out of sight, out of mind that took it before I got my hands on it and got my nails done. Right? I had to set up an automated no money account. And I can't look at it. Ask me how much money I have in emergency funds. Ask me. Say, Rochelle, how much money do you have saved? Ask me. I don't know. You know why I don't know? Because I can't look at it. I can't look at it. I know myself. Know thyself, right? I know myself. So I can't know. So I have several accounts set up so that when my mama, who's 80, needs something, medicine, some kind of emergency, I got her. And I can go in that account. I just unhooked myself. Right? So we have to set up something here, out of sight, out of mind, that's automated. This is what keeps us locked out of the financial system. Because if you don't have at least 6 months worth of emergency funds, people like Bill, you never meet them. They will not come and see you. Does that make sense to y'all? Right? And it's so easy. You just set aside 10% minimum of everything you earn into a no money account. Yes? Thank you. Here's the other thing. Whoop, hands up. In there, around here, in the back. Okay, the other thing is putting money into a passive income bucket. I heard this from Warren Buffett. He said you got to have money going into something that creates passive income. And I'm like, what is that? Right? Well, tell me one thing that you can put money in that creates passive income, Bill.
There's a lot of stuff. I think you're going to get this all.
Mm-hmm.
But dividend-paying stocks.
Yep. Mm-hmm.
Some of the things that we work with a lot of the annuity products.
Annuities, right?
so the idea behind passive income is you don't have to work. You don't have to put your hands and do some physical labor to produce that next dollar. You're having your own business, right? That can be a passive income, or it can be a good job.
Right.
It could just be you have another job, which is not passive. Or if you created it properly, you got some people working and benefiting from the business in addition to you, but they're doing 90% of the work.
Yes.
But you're getting paid.
There you go.
That's passive.
So the rental property that you have, and they call you at 11 o'clock at night and say the toilet broke, and you have to get up and go fix the toilet, is that passive? No. Right. Right? But if rental property has a rental company, or you have contractors that do all that, and you stay in the bed. Now, is that passive? Yeah. Right? So that's what we just needed to.
But you have to pay contract.
You have to pay. Your money is doing the work for you. Right? So, but the one thing that people badmouth in the industry, not us, of course, because we're holistic, but financial advisors don't make money off of annuities. The commissions are between 3% and 10%. So they don't advertise annuities. They make money off your brokerage account, even when the stock market crashes. So they'll make a passive 2% or more off your brokerage account for the rest of your life, right? So I thought to myself, why is it that annuities are being badmouthed when that's the one thing you can put money into, stop, and it just pays you for the rest of your life? It's a pension. It's Social Security, right? So why are we learning about that, okay? And then the investment bucket. That's number 3. But it goes in this order. Without this order, your finances fail. Emergency funds first. You don't take your rent money and put it on the stock market. That's why they won't take you unless you have 6 months worth of savings. Because you're literally taking your rent money, your car note, your light bill, and putting it on the stock market. If something happens, right? So 6 months first. Passive income in 6 months can go together if you have the cash flow, if you're not living paycheck to paycheck, right? And then the investment buckets, power move 1, 2, and 3. How easy was that? If you were in the 5th grade, could you learn that? That's what we should have learned it.
That's right.
Maybe even the 3rd grade. We'll put $1 here, Mom, right? Right? Basic financial literacy. Yep. Bill, I feel like you want to say something.
No, you good.
Okay? All right. Always keep that 6 months out of sight, out of mind, ladies. Know yourself. Know that if you're a spender. Where are places where you can put your emergency funds? I use my life insurance policy. I have a specially designed life insurance policy. I can put up to $132,000 into my index universal life insurance policy, and it's tax-free because it's called cash value. So as an entrepreneur, at the end of the year, we pay taxes. Suppose I didn't have enough for some reason. No, Jesus, no, don't take that. All right, I'm always going to be in abundance, okay? But if something happened and I needed a place to get money, my life insurance policy keeps it tax-free, and it keeps it growing at 5 to 7% interest. People don't know that. Yes, ma'am.
The interest on what you're getting from putting it in your life insurance?
They pay me interest.
But you don't have to pay taxes on that?
No, ma'am, because it's part of the death benefit.
And let me give you a good example of this.
Mm-hmm.
Because most people don't look at this the way that she's saying it right now.
Mm-hmm.
So life insurance, when it was designed in the law, you have funds that can build up inside of this life insurance policy. Let's say the life insurance like an umbrella that has the life insurance part if someone passes away, but it also has a savings component or investment component, right? As you are earning interest on it, it's classified as tax deferred.
Mm-hmm.
So you don't pay interest on it while it's building interest inside. I mean, you don't pay taxes on it while it's building interest inside.
Right.
When you go to take the money, or you need some of the money and you want to go buy a car with it, or you want to do something else, you usually take the money out if you really want to leverage it, as Rochelle was saying. You take it out as a loan.
Loan.
You borrow the money from yourself,
Right.
from that policy. So if you go to the bank and you take out a loan, do you pay taxes on the money you borrow?
When you take out a loan, do you have to pay taxes?
No, they don't. You don't pay taxes on loans, right? You pay interest on it, and you pay interest when you take it out of there if you take it as a loan. But who are you paying the interest to? It's your policy. You took it out, you're paying interest to yourself, right? And so that's the idea behind that. And by the way, that's done on a big, big scale. You guys have seen everything in the news about these billionaires not paying taxes,
Right.
right? So a guy who owns a company, and it's a huge company, he's CEO and everything else, and he gives himself a salary, but his salary is $1 a year.
Right.
So that's
Right.
his salary. That's his earned income.
Uh-huh.
$1 or $10,000, whatever it is, it doesn't. You don't pay any taxes on it, really, right? So how's that dude living? Goes to the bank. He says, "I got $10 billion worth of stock. Loan me a few $1,000,000 to live on."
Loan.
Loan, just like we said with that life insurance. Loan me $10 million so I can just have spending cash, right? The bank loans him $10 million using the stock as collateral.
Stock is collateral.
So what do you think his interest rate is?
3%. Simple.
Maybe 1%, 2%.
Wow.
Something very, very low. Because if he defaults on it, they have to stop.
Yeah.
Right? There's no risk. So he barely pays any interest on it. He gets $10 million. What does he do with the $10 million? You think he just goes out and blows it? No, he buys a bunch of real estate and he earns 15% on the money after he just borrowed it from the bank for 2%.
2.
And then he's, so it works like that. He's got more assets to borrow more money and so forth. So they don't hardly pay any taxes, but they still have a wonderful life and so forth. In this case, you borrow the money from your life insurance policy, and you can pay it back if you like. You can use it to make more money, as Rochelle was talking about, right? Or pay yourself back over time. And if, God forbid, something were to happen to you in the meantime, the death benefit pays off the loans that you have.
Right.
Plus, still leaves money for your family, by the way.
Right. Yeah.
What did we say before? There's nothing new under the sun, right? This has been in effect forever.
Right.
The reason I cashed it in is because the premiums that I would pay when I turned, I think it was it 70 or 65? Went to like 4,000.
Too high. Right.
Good gracious.
So, yeah.
In the world.
Because you could choose the investments.
Uh-huh.
See, the problem is if, like she was saying, we could have learned this in the 3rd grade or 5th grade and all this stuff, right? Even as adults,
Right.
very few people are taking the time to walk you through it and to kind of hold your hand to build it properly. We should be loading so much money into life insurance. I had a client, worked for IBM, then retired, started another company, started businesses. But he had $500,000 in his retirement account. We sat down and he decided, I'm going to put $150,000 a year into my life insurance for 5 years. That's $600,000. So now he just moved all of that money into something that basically works like a Roth. You're
Right.
building a lot of money without paying taxes, and he knows he can borrow against it, buy a property, flip it, make money on the property, put it back. So just things like that. So if people are telling you how to use what's already right there in front of you properly, there's a lot of opportunity. And this is just one of them, but
Beautiful. I love it. Thank you for those examples, Bill. So just my own example is I'll borrow 15,000 or 10,000 and I pay myself back fast because the cash value goes on steroids. And at the end of the year, I've got 2 times more cash value. Just like when you pay back a credit card, you don't let it go past a certain amount of time. Same thing with that. So it's called the rich man's Roth. If you want to look it up online, it's called the rich man's Roth. Is that concept. Now, I have a question for you. Let's just say you open up a savings account at PNC Bank and they're paying 0.3% interest. Okay? Right? But let's just say you could open up a money market account, which is basically the same thing at Goldman Sachs, and they're paying 4.5% interest. Which one is better? And which one is leveraging? Right? Annually, it's always AP, annual percentage rate, at savings at the bank. Right. High yield savings accounts and money market accounts only, ladies. Everything else in your money is dying on the vine. Your money is going backwards because inflation is at 5 to 8%, and your money is growing at 3%. Basic math, that means every year your money is depreciating by 2%. Sitting in the bank, not including the fees, just maintenance fees, ATM fees, all of that. They're leveraging you. You're not leveraging them. Make sense? High yield savings accounts, money market accounts. Yes, I have a pamphlet that I can email you or send you if you want a list of what is current on that, okay? Savings accounts and money market accounts. That's where your 6 months goes. What the emergency funds is. Is that good information? All right. Okay. So this is a list of things where you can put your money. Only 3 places on this list create a passive income. Here's a trivia question. You have a notepad in front of you. Write down the 3 places where you can put your money that create a passive income for a prize. We're going to check your homework. It's only 3 on this list that create a passive income. What are those 3? And anybody who has it right, you're going to text me. I'm going to send you an ebook, okay? 3 places. Okay, and raise your hand when you're ready. You got it. You got it? Okay. 3 places. Okay. Uh-huh. You got 2. That's good. She got 2. Yes. Good job. That's a B+. You can still get into college with a B+. Okay, anybody else? Anybody else want to try? Yes.
I did the high yield, the dividend paying stocks, and the universal life insurance.
You got 2.
I got 2.
You got a B. Y'all got 2. All right. Passive income. That means you don't have to work. Income is income.
I know.
No, you got y'all warm. Y'all not hot. What is it?
The annuity.
The annuity. The annuity is the same as Social Security. It's the same as pension. You put one lump sum in there and it pays you for the rest of your life. Pays you a guaranteed income for the rest of your life. It depends on what income you want. Just the short of it, there are 4% to as much as I've seen 7 to 8% roll-ups.
Yeah, she is saying what's the minimum amount you can put in the account.
Right.
Most of them, depending on what you're doing, most of them are about 25,000.
Right.
There's some circumstances where it might be a little lower.
Right.
If it's just rolling over some money, they might go lower. But as a rule, just think
25,000.
It's
Right.
about
Right. 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 And when I say roll up, I mean, say if there's a 4% roll up, which is the lowest. If you put $100,000 in there, it'll pay you 4% of that account every year. So it'll pay you $4,000 a year for the rest of your life. Okay. A 7% roll up, it pays you $7,000 a year for the rest of your life. If you have $100,000 in it, y'all visualize what I just said with that?
Could you say that again?
Okay. So for an annuity, she's saying, how much can you put in there? Annuities have something called roll-ups. Write that down. Okay? What is the roll-up rate? That is the percentage that they're going to pay you of what you have in there for the rest of your life. Okay? So if you put $100,000 in there, and you talk to me or Bill, and there's a 7% roll-up, you're going to get paid $7,000 a year for the rest of your life. Did you get me? Okay? If it was a 4% roll-up, like somebody's kind of new in the industry or somebody, and it's only going to pay you $4,000 a year for the rest of your life. Did you get me? Yes. Okay. So you wanna have. That's why these statistics say you need $100,000 into a pension or annuity or just to get some type of income.
So,
Good question.
So one question I would put out there in regards to that. So we're seeing annuities might pay you a certain amount, which is guaranteed, never to run out. The payments keep coming no matter what happens in the market, right? So these are companies guaranteeing your payout forever. So if you took that same amount of money and you put it into a mutual fund,
Right.
okay, which is stocks and bonds kind of pooled together in a little package, right? So a mutual fund, you can lose money if the market goes down, or stocks and bonds, you can lose money if the market goes down, and you can gain money if the market goes up, okay? So what is the amount of money that's safe during retirement to take out of a mutual fund account? Since it can go down and go up and go down. These other ones are guaranteed. So let's just look at that other one, the mutual fund. How much could you take out safely to make sure you didn't run out of money from age 65 to 90, let's say, during a retirement age?
Do you know?
I'm sorry.
That's okay.
Questions.
Yes.
What does the annuity invest the money in?
Good question.
And is it insured in any way?
That's
Good
really
question.
Good. So hold on to that for just a second.
I love
I
it.
will answer that.
I love your question.
I promise you. But what you just asked was a big question, right? It's a big, big, big question.
How they're not affected by the economy?
They are, but I'll absolutely answer that. I don't want to take you in the weeds that far yet, but I'll absolutely do it. So let me give you.
Have some snacks, Keisha.
Kind of rhetorical thing, right?
Oh, I promised y'all lunch at this time, but go ahead.
Oh, yeah.
We gotta go. We gotta get lunch and then we'll finish it. Go ahead.
So there's a thing called in the investment world. There's a thing that brokers used to call the 4% rule, and that says you should never take out more than 4% per year. Never take out more than 4% per year of any funds that you have, like in mutual funds or stocks and bonds. That's the most you should really pull out for it to be relatively safe. When the interest rates fell before we just had that last big inflation thing that hit us, prior to that, interest rates were really low. I mean, they're still low even now, but interest rates are real low. That number went down. So it went down to about 3%. So the safe number, if you got mutual funds, is don't take out more than 3% per year.
Yeah.
So you got that as a
4 to
choice,
3%. Yeah.
but you can still lose. Or a portion of your funds, doesn't have to be all your money, but a portion of your funds being in something where they give you a bonus the first day, has a guarantee that you never lose any money from market downturns, by the way, which really makes her want me to answer her question. Because it's guaranteed not to lose any money if the market goes down, right? And once you start taking funds out, You don't give up the right to your pile of money that you put in there, by the way.
That was my
You don't get,
Right.
you can, oh, the annuities that years and years and decades ago, people would, here's my money and here's my payout, but I can't change my mind.
Right. You
I
can't.
gave up my money for the payout. That's not how they work now.
Yeah.
You still have a right to your funds if you want, but you can get a payout that's guaranteed for the rest of your life. And those payouts are, you know, like she said, somewhere between 4 and 7,
Right.
but they're guaranteed. And you got bonuses on top, and you
Yeah.
didn't lose any money at any point
Right.
in the process. So it works out very well for a lot of people.
Right.
I'm gonna hold my question because I know you want.
Whole question.
But
Yeah.
I will answer it.
Yeah. So, how? What do they invest in? Same thing, everybody. The S&P 500, Russell 2000, on and on. They buy bonds, and they, all of that. But are they insured? Annuities are a life insurance product.
Life insurance companies are the ones putting
Yeah.
doing the things for you, right?
So the life insurance company takes the risk. That's the reason why they guarantee your money, right? And we'll get into a little bit more of it, but you're going to get stock market gains and take no losses.
Which really makes you want to answer the question, right? How do they do that? How is that possible?
It's a life and day. If you've got $100 billion and you've been around since 1842, my managers were saying, everybody get $1 million worth of insurance. I was like, what? I was a single mom living in a government subsidized apartment. I was like, I don't know if I can afford $1 million worth of insurance. And then they said, no, then he looked at me and said, do you want to leave Solomon $1 million? I was like, yes. Right? I said, but could I afford it? Right? And at the time, I knew I couldn't. So I did $200 a month in term and just did half. And then I started overfunding it and funding it like I wanted to, because this policy has a flexible premium. So sometimes you can drop 200, sometimes you can drop 500. So I started tithing to myself in this policy, and I did Solomon's, I did Mom's. If y'all know my mom, she was 75 at the time. She's 80 now. So I did hers, and she started overfunding hers, and she started being her own bank and borrowing and all that, right? So so now the cash is loaded. It's loaded, right? And all of us have these policies, and they have the S&P 500, some of the Russell 2000. It's got a money market inside. It's like a fixed 3.5% interest inside there. And I love it. So at age 65, I'm looking at $5,000 a month. When I can take your chair class, I can be in the chair with y'all when I'm 65, right? And then this policy will pay me that $5,000 a month tax free. It'll be paid up, and I don't have to pay it anymore. It'll pay. I'm not supposed to tell y'all numbers. I talk too much sometimes. But I did. I got 2 policies to equal out $1 million. And then y'all like, have y'all ever met my son? Like, why in the world would you leave an 18-year-old $1 million? And what is he going to do with it? Well, I bought him the car, so he's not going to buy a Lamborghini. But what you do is, what Wayne and I were talking about, is you put the policy in a trust. That guy right there, right? Excellent on trust. So you say, okay, Solomon, 20% of this has got to go to pay for a house, right? Solomon, you got to marry a woman that has this caliber before you can take this amount of money out, right? Sustain the money, right. You got to take this much money and put it into an annuity so that you're paid $50,000 a year for the rest of your life, right? So you take your trust, you structure it so that your kids don't run through the money and destroy themselves. Make sense? He's going to use it for education. If, I'm going to be, I believe I'm going to be 100, because I'm up in here in Plus with you all. And y'all are taking line dance at age 85 and stuff. So I'm going to take after y'all. Okay, but that's the policy I have. And I'm not going to go through all of that. So I don't want to beat a dead horse, right? Okay, Miss Irma. There are 3 different types of annuities and growth accounts, Miss Diane. Okay? There's a fixed account, which means they're only going to pay you one interest rate, and that's it. So they'll declare that it's 4% for the year, and it's fixed. It won't go higher or lower, right? Okay? There's variable, which means you're buying stocks on the stock market, goes up and down, right? And then there's index, fixed index, which is a combination of a fixed interest rate. So when the market crashes, you don't lose any money. But when the market goes up, your money goes up. Okay? 3 different types of accounts. These are the only 2 you see all the time. And they can work your nerves. Because this one doesn't pay enough money to stay ahead of the cost of living. And this one will give you gray hair if that's all the money you got. And they lose 30% of it, right? So in my opinion, for your retirement money or money you don't want to lose, this is the best one. Because you're going to earn stock market interest rate and you're not going to lose a dime. Combination, it's called an FIA, or fixed index account, or a fixed index annuity. Questions? Questions about it? Was that clear? Both stocks and a guaranteed interest rate.
So in other words, when it's fixed and flat, and the other combined, it can't go lower than the 4%.
Right, if that's your fixed interest rate, or 2%. A lot of them have a 2%, or some have a 0 floor. The terminology you hear on the news or on the stock market is a floor. Okay, what is the floor? Right? So the floor is 1%, 0, 2%, whatever. Yes, sir.
But even 0 floor is good.
Mm-hmm.
Because that means if the market goes to -10, your minimum, your floor is 0. Meaning you don't lose anything. You'll have the same amount that you had before the thing fell. Even a 0 is fine.
Mm-hmm.
Right? So, and this is kind of ties back to your question, really, how they do it and everything. And I'm going to mention this because during the lunch thing, a couple people actually suggested this to me. To explain these things in detail is we don't have the kind of time to do it for you right now. But Rochelle and I are happy to sit down and talk to you on a Zoom call, on a personal,
Right.
one-on-one, all of that stuff. And there's no obligation to it.
Right.
So as deep as you want to go into it, we're happy to go into it.
Yes.
It's just that we're on the time frame. And
Yes.
we wanna
Yes.
take it
Yes.
forward.
Thank you, Miss Diane. I know that you have to go. A 5th grade education can learn this, right? Really plain. But they don't teach this to you in school. They just take your money and put it on the stock market in your job. Or you put it in the bank at a 2% interest rate and your money don't grow. And then you're constantly putting money and say, why I'm not rich? I've been putting money in it for 30 years. Why am I not rich? Because the stock market keeps crashing and it doesn't recover and all of that. Or it's not keeping ahead of inflation. Ma'am, Miss Irma, you took a big deep breath and the breath was coming out of your mouth like you wanted to say. Taxes too, that's another thing, okay?
And in the high yield, I have to pay interest on the taxes at the end of the year.
Right.
So, but you're saying I don't have to pay taxes on that?
In a Roth or a life insurance policy, right?
But,
Okay.
I'll mention this, I'm sorry, one last thing.
Uh-huh.
With the annuities, like you said, you have to pay taxes every year on the gains.
On my
With the high yield. With the annuities, it's tax deferred.
Right.
So year by year, you're not paying taxes on it as it's going. You will pay taxes when you pull out, and only on the gains that you earn when you pull. Good question. These are.
All right, so I want to
She
do
was
this.
asking if any of the companies ever went bankrupt.
No.
So the life insurance these are life insurance companies.
Right.
And I will say, companies do go bankrupt. I mean, very, very seldom you ever hear about a life insurance company.
Right.
Has anybody ever lost any money from one of these types of accounts? Is a better question. And the answer is no. From a company going bankrupt. And when you were asking about guarantees, every state, by the way, the Department of Insurance,
Right.
they manage, insurance company is going to operate in Virginia, they have to work with the rules of the state. And so all of these annuities and life insurance products, they do have a guarantee, but the guarantee is backed by the companies themselves, backing each other, and the state. So if you look at in Virginia and find out what's the guarantee on any of the accounts in the annuities, they'll say you're guaranteed up to like $350,000. If you look it up online,
Okay.
the Department of Insurance will tell you for that state what the guarantee. In North Carolina, it's $350,000. That they'll guarantee to that level.
All right. Trivia question. Who do I pick on? Who should I pick on? Rosalind, with your bright-eyed self. What is a fixed index account? It has a floor, so that a guaranteed interest rate, and then you get this stock market growth. Yes, ma'am. So it's a fixed, so that's the floor, guaranteed. Index is the market gains, and then you can put it into a growth account, which means you can go in there and take lump sums out and keep letting it grow, okay? And you can put it into an annuity, which means it turns into a lifetime income. Was that basic? Yep. So an FIA is a fixed index account or fixed index annuity. Yes? I should teach high school. No. I'd rather do this. Okay. Dividend paying stocks. Question. I hear a question. Go ahead and ask your question. Okay. All right.
Are you required to take payments from the annuity?
You can turn it on and off at will. Okay.
The only requirement is if you
Random
if it's
minimum
a
distribution.
IRA,
Like a certain age or something? 'Cause I'm 90.
it's this. You say you're what?
I'm 75.
Oh, so that's
Wow, that's crazy.
I feel
75.
The only thing is going to be the RIAs,
Random minimum
required,
distribution.
Yeah.
Okay. So we've drilled y'all on the first 3 steps, and we want you to go tell your children. Go tell it on the mountain. Put 10% of every dime you have in a no money account. My son has more money. I don't know how much money he has, right? So start your children saving. Start your children with thinking about passive income, Roth IRAs, annuities, dividend paying stocks, things like that. And then the investment side, right? Once you got your ducks in a row. Here's the 4th power move. I didn't find out about this one until I met Bill and got in there with the $1 million round table because they wouldn't let my little self in the door. You know, they got guys clubs. Hello? I found out and I was mad. And Bill can tell you I was mad. I was like, you better tell this to us and tell it to our people. I was like, if you don't hurry up and get me in this door. And I don't want to talk too much, but I found out about this. You have to be at the $500,000 mark or higher to even open up the door. And this door opened up to me, and now I'm opening up to you. What is the door? A high bonus paying annuity and high bonus paying accounts. This is where you roll your money into an account, and the life insurance company or an investment company will pay you a bonus between 15 and listen to this, 30%. Immediately. You have to be in there for 2 years to do a rollover. So we'll talk.
No, when she said 500,000, she doesn't mean you have to put 500,000.
I had in production and a new year. An advisor that does a lot of business before the companies will share it with you. So a lot of what we call it street agents, really, they don't know about it. They won't ever see it. You have to be at 500,000 in production or more to even see it. Okay?
It's the same one as
$25,000. And that's what made me mad. Yeah.
You know, it's not, you don't
Yeah.
have to have
For $500,000. Yeah.
Yeah, but like she said, these are 15% to 30% bonuses that people get, and that's the first bonus. That's the first day,
First day.
and then depending on what type, you know, what's best for you, there may be more incentives as you move forward.
So this was a client that we did, and she wrote over $400,000. This company gave her a $108,000 bonus day one. This is a growth account. So after she's had this account for 1 year, she can just start pulling 10% of the cash. And just so 400,000, her account jumped up to 520,954. If she needs emergency money, how much of this can she get? 52,095.40. Boom. And she can take anywhere between 1% and 10% of her money out of there. And then Bill and I reallocate the money, make sure that it stays up. There's a floor so that when the market falls, she won't lose a dime. And then he and I mix the magic sauce so that she can just take money as she wants to. Now, if she skips a year, say she said, I'm not going to take 10% this year, I'm going to take 10% next year. Next year, she can take 20%. Right? If she wants to come in and cash it in, she can cash it in, but there's a surrender charge here. But the whole idea is to be your own bank. Leverage the $100,000 that they gave you and use it to secure your life, not spend your money down to the line of zero. Every time I violated the principle of being your own bank, I ended up broke because I stopped leveraging free money. I stopped leveraging loans, and I just started going in my account and spending everything down to zero. Right? So we encourage you. You can do what you want to do. We're not checking looking over your shoulder. She can go in there and take $5,000 out if she wants to, right? But we're saying 10%, 7%, so you can keep growing it, right? All right. Now, client two. Yes, ma'am.
What kind of effective age have on
They take you as long as you're under 80 years old. Because if you're over 80, you live past the Social Security life expectancy. So if you're 79, right? 79. Okay, now, here's another client. She worked at the IRS in D.C. What happened when the government shut down? Okay? She was forced into retirement. Took her thrift savings plan and was like, what am I going to do with it? Bill and I worked with her. She took $600,000. It's somewhere in here. Here it is. She got a $180,000 bonus and $4,875 from the market increase. So $184,875. She sent me stuff for Christmas. You would have too. Oh, well, easy. You have to have 6 months for the savings before you can roll it in here. Okay? We cannot take more than 70% of your assets. Total assets.
So the idea is, remember those buckets which you had 6 months savings? If you look at those buckets again, you see two things. You see guaranteed, predictable income and growth, and you see liquidity. So in case you need to go get your
roof fix,
water tank blows up and you got to spend some extra money, or you need a new roof, or you got to buy a new car.
right?
So you should have some liquid cash that if you need to, you can get your hands on. Now, The life insurance plans we talked about have liquidity in those, because you can go in there and get what you need. But you need to have some sort of liquidity. And these are the guaranteed growth, the bonuses, and the guaranteed income flow.
Right.
Come from stuff like this. So you need a balance. So we don't do it anyway, but you don't take more than you leave about 30% of
Yes.
the cash someone has for sure.
Yes.
At least 30% should stay outside of a plan like this.
Yes.
Because this has some restriction to it, right? It's phenomenal, but like I think your question all of your questions came to one thing. If it looks too good to be true, it probably is, right? So these things are, the insurance company is saying, we'll guarantee all this stuff, but all you gotta do is hang in with us for a while.
A year.
Just don't leave. Just don't take it all and walk away.
Right. You have to be a
I'll
year.
tell you something, my daughter, because I said, I think I'm getting Alzheimer's. I think, Mom, when you don't know where your money is, then I
Whoa.
ran Alzheimer's.
Oh, I know that's right. So, okay, this particular one, you can't touch the money for 1 year. Right? So since you can't touch the money for 1 year, they want to make sure you have at least 6 months worth of savings or more, so that you don't have to touch the money for 1 year. They want to make sure that your cash, so that your income is 50% or less than your expenses. So if your income is $4,000 a month, your expenses need to be $2,000 a month or less. Right? You're not living paycheck to paycheck. If your income is $4,000 a month and your expenses are $3,500, we can't help you. You're not going to qualify. Right. They won't take you. They won't let us do that. Right? So we have a green sheet. We take about 30 minutes to 45 minutes. We have a green sheet. Real easy. We plug in the numbers and we say, voila, you qualify for a 15% bonus, 20%, 30%, based on the results of our plug and play sheet. So we'll tell you. And it's fun to do. You should just do it too for me, just because you like looking at money and stuff. So you should. But this is a real client. So and I don't even tell you all the sauce. This is the bonus. So she retired. They just started paying her a retirement check from the government in December or something. She didn't get her retirement. She had to wait for a retirement check, right? So we know we had to leave her liquid, right? Right? So she said, you know what, Rochelle, I'm going to do a little bit of teaching on the side, and I'm not going to take this money till I'm 65. So she's going to just set it there. That's what's her TSP. And at age 65, Bill and I have this allocation, and he and I go back and forth. I know it looks like we gel, but sometimes, boy, like, okay, Bill. Right? So we found this secret sauce where at age 65, she's going to take out over $100,000. And then it doubles every 5 years, her income.
So it continues to grow after you start putting money.
And the old school annuities, you'd give up your lump sum for an income. The new school annuities, you don't. So if she says, you know what, Rochelle, I'm just going to take a lump sum and quit, $569,000 or whatever it is, she has liquidity. So we have accounts that you can take either or. At any time, you can turn on the the income or turn it off. You're in control. You have access and control.
One of the
Nice.
things I will point out, if you look at the last 2 columns all the way to the end, the
Ooh,
last
I'm
column
sorry.
was her income.
Oh, let me go back here.
Okay?
Income.
Yeah. Let me show it to you. Yep, there you go. Mm-hmm. If you notice, that income doesn't stop.
Oh, yeah.
It keeps going as long as she lives.
Yes.
Right? Next to it, what's that one? Protected income value. That's the pool of money that pays the income. Mm-hmm. But if you notice, the pool ran out.
Right.
Because the person's living on big chunks of money. It ran the money.
She drew her money down to the line of zero.
But guess what happened? What happened to the income when the money ran out?
Income keeps going.
The insurance company.
The insurance company.
Not only that, it continues to grow.
Right.
So it's guaranteed
How
I can give you a fast answer, right?
fast?
So like she was saying, the money grows based on the growth of investment things like the S&P 500. So if the S&P 500 goes up 10%, your account will probably go up 6, right?
There's a cap on some of it.
Okay, because we put a little cap on it. So in other words, if we're taking away all the downside risk, we have to have some of the top side.
Some of it's
Companies
cap.
saying this, right? We got to have some of the top side. But guess what? They never actually put your money into the S&P 500. Your money goes into the insurance company's general account. They're awarding you interest payments and bonuses and everything based off of the movement of those indices that we were talking about, index, right? So you get credited based on the movement of the index. But they take your money and they put it in the insurance company's general account. Insurance companies make their money different than the rest of us. Right?
They sure
make their
do.
money, they sell insurance, someone passes away, they pay off the premium. The term insurance, which don't have any cash value, guess what percentage of term policies actually pay out to people?
2%.
2 to 3%.
Yeah.
Of all of those policies and all of that premium, only 2 to 3% of the
2%.
people actually get a payout because most people lapse them
Right.
before it's time. So it's like cash cow for them. They are geniuses at knowing. If there's a room of 1,000 people, they can tell you how many people in that room are going to die this year.
Yeah.
They can't tell you who, but they can tell you how many, right? So they do all their measurements based off of that. Insurance companies are the most profitable businesses in the world. And they don't make, on their money, they don't make 10% returns. They make huge returns, and they're giving you a piece of it. That's how they're doing it.
That's how they make money.
There you go.
All right, so the last part is power move number 5, and that is put your cash, accounts, your annuities, your life insurance policies inside of a trust.
There's a whole bunch of reasons. And we don't sell trusts, by the way. But
We can assist you, point you in the right direction.
we have a partner who's an estate planning attorney. We have directions to estate planning attorneys.
Right.
But so beneficial.
There's even a lot of tax benefits as well. If your assets are at a certain level, there's a lot of tax benefits to putting your account into a trust. So if you're at the $2 million mark or more in assets, that's real estate, cash, annuities, pension, all of it, then there are annuity trusts once you make it irrevocable, which means it can never be changed, where the money can come out tax-free. Now, the funny thing is, when I sit down with people, some people don't even know they're millionaires until I put it all on paper. Look at your house. Look at your car value. Look at this. Look at you're a millionaire, and I'm slapping your cheeks. Look, no, I'm not. No, I'm not. Yes, you are. Look at the paper. And I have to tell you, you're a millionaire. So I can get you this. I'm like, can you trust God? Can you trust God? You don't even see yourself. Y'all can see I'm fiery. Just like when I teach my exercise class. So you go into another category, you didn't even know you were there. You would have been stuck going around in this 3%. I'm going to get me a CD. It's 3%. And this 5% thing. Because you didn't even know you had the assets to join the classes and stuff that most people don't know you can get. Does that make sense to y'all? Yeah. Rockefeller is the last thing, and then we're going to be done. So the Rockefellers they put their life insurance policies in a trust. You can only do this with whole life or universal life or something that's a permanent cash value policy. And then every time a Rockefeller is born, The trust buys a life insurance policy on that Rockefeller and when that Rockefeller passes away, it funds the trust. And the trust gets bigger and bigger and bigger and bigger every time a Rockefeller is born. And then they have stipulations on this trust where you can't go to jail and smoke weed. You got to marry a woman that's got this much class, and they have these stipulations, and then they get millions and billions of dollars for hitting these benchmarks out of this trust, and they're called trust babies. Now, you don't have to be a Rockefeller to get a trust. $3,500 to get a trust and protect your family and protect your legacy and grow your generational wealth by putting your annuities and your investments and your insurance in that trust and just passing on generational wealth. Yes, ma'am. The law firms charge. Yeah, and we can help you too. We can guide you so that you don't get taken. Bill knows, and that's one of the things I got with Bill about. Check it out. Here comes the fee. You ready? Bill's like, oh Lord, here she goes. Here it comes. All right. So how much is all this worth? I'll tell you what it's worth. If you go to XYZ, Edward Jones, and you say, make me a retirement plan, they're going to charge you between $2,000 and $5,000 just to say, here's a retirement plan. They don't do anything. They just here, and they'll give it to you in writing. Right? That's the cost of just a retirement plan. Tax shelters, $20,000 out of your account. Converting your life insurance, so doing a Roth conversion with your life insurance. And then direct access to the partners of the firm. There's no price on that. You can call me all the time and sit down with me, right? Right? How much, that's priceless. Our value is worth $55,000 minimum per person. And I'm not kidding you. I'm not kidding you. What is our charge? I'll tell you what my charge is.
Nope, I'm gonna stop her.
He's gonna stop me.
Someone adds up all the stuff and says it's worth $55,000, then they're gonna say they're gonna give you a price and it's gonna be
Like half.
You know what I mean?
$10,000 will do it for you. Referrals.
If we're helping you, we can't help people we don't know. And so we ask that you help us by introducing us to other people. That's the end of the charge. We get paid by those companies. If you decide to do something, the companies already have it baked into their fees that they got to pay us.
And they,
But
right.
if you use us or not, if you went online and did any of this stuff, if you could figure out how to do it, it would be the same price that it would be if you worked with us. They're gonna pay us. So out of your pocket, and also if you went to a broker, a stockbroker, they put together a fee for you.
Right.
They're gonna charge you 1.5% to 2%
Per year.
Forever. Every year of your total.
It'll come out of your account.
Every year comes right out of your account.
Mm-hmm.
When we get paid, and you get an annuity, like we said, right? Let's say you got an annuity. Not only do you not see your account fall in value, most of the time, like we said, you'll see it go up by the bonus. None of our fees come out of your balances.
You're not right.
Because the companies have it baked in over time. They pay us.
All right. So what we ask for is
We don't charge for the planning work.
right. And we do a lot of hard work in planning. We put our foot in it, like your grandma said with the meal. We do. But 10 referrals is what we ask for. That's it. And we do it the professional way. You talk to them first, because I don't like calling people on the phone, honestly. I have to make myself call, and I have people to help me call. And I don't like calling people and they don't know who I am. I'm very vain. So I ask you to text them on my business card. and tell them, hey, is it okay if I send her your way? And then that's a referral. Referral is when you talk to somebody, you refer them, right? It's not a cold call if they don't know who I am that you didn't tell them first. So we ask you to talk to him, tell him, and then that's it. Then you have us for life. Yeah. So referrals is what we ask for. So now we want to just invite you to book a session with us. You can take a picture of this, book a 30-minute, call first, and talk to us by phone. And then let's get a feel for where you want to go. So that's my cell phone number. Go ahead and take a picture. Yeah. And just text me and say, Rochelle, you owe me an ebook or whatever. And then we'll talk on the phone first. And then from the phone, we'll book a Zoom call if we need to get together and see what's going on. And then depending on how many moving pieces, Bill, Ben, we have a team that's really strong that you'll be working with step by step. My favorite day is the day that you open up your account and see your bonus money. I'm not going to let you touch it. Y'all laughing. How y'all act like y'all know me. I won't let her touch me for a year, right, Way? Way can tell you I won't let you touch it for a year. Yeah, but when it's time to turn on the money, I might not see you in class anymore for a little while. I'm not kidding. I may not see you in class for a little while. So here's my little thing. You can take a picture of this and then we can go. That's my QR code. If you scan it, there's my calendar will pop up. And then you can just pick a day and time, say Rochelle, Friday at 3 or next Tuesday at 2 or whatever. And you can just book me off